One contribution, maybe $200, maybe $500. You close the app, get coffee, continue your day. But your money does not stop moving when you stop looking. That tiny contribution joins millions of others. It enters pension funds, index funds, bond portfolios, insurance reserves. Then, somewhere inside the financial system, software begins asking questions about it. Thousands of questions, every day. What happens if interest rates jump 1%? If oil falls 20%? If a bank collapses? If a war closes a shipping lane? Your retirement money becomes one microscopic signal inside a machine monitoring an estimated 21 trillion in assets. Its name is Aladdin, and it belongs to BlackRock. Not the lamp, not the genie. Aladdin stands for Asset, Liability, Debt, and Derivative Investment Network. A cold name, an accurate one, because Aladdin is less like an app and more like the operating system beneath institutional money. BlackRock is famous for managing money, but Aladdin sells something even more valuable: visibility. One system connecting portfolios, market data, trading workflows, accounting, compliance, and risk. A single view of what an institution owns and what could destroy it. BlackRock does not own $21 trillion. That distinction matters. The platform analyzes or supports assets managed by many different institutions. Pension plans, banks, insurers, governments, rival asset managers. The money has different owners. But increasingly, it speaks the same software language. The system began with a loss. Before BlackRock, Larry Fink built mortgage securities at First Boston. Then his desk lost roughly $100 million after interest rates moved against it. The lesson was brutal. Profit means nothing when you cannot see the risk accumulating underneath it. BlackRock was built around that wound. Measure everything. Model everything. Never let portfolio managers hide behind instinct. Every bond, every currency, every derivative, every maturity date, every correlation. Turn uncertainty into data, or at least make uncertainty look measurable. Today, the commonly cited estimate is approximately $21 trillion connected to Aladdin's analytical ecosystem. That is larger than the annual economic output of almost every country on Earth. Not money sitting in one vault. Something more subtle. Money viewed through one analytical lens. Aladdin watches exposure, duration, leverage, liquidity, counterparty risk, currency risk, credit risk, market risk. It asks how portfolios behave when normal assumptions fail. Because that is usually when human confidence fails, too. Imagine a pension fund with $80 billion, stocks in America, government bonds in Europe, property funds in Asia, private credit, infrastructure, currency hedges. Aladdin can model what happens if inflation returns, rates rise, equities fall, and liquidity disappears at the same time. The output looks clean: a loss estimate, a probability, a red number beside a portfolio. That clarity is powerful. It can also be dangerous, because the screen may show 2.4 billion at risk. But the decimal points do not make the future predictable. They make uncertainty easier to approve. Aladdin does not merely produce reports for executives. It sits inside the workflow. Orders are prepared, compliance rules are checked, positions are reconciled, cash is tracked. Risks are recalculated. Tens of thousands of institutional decisions can pass through connected systems every day. A large fund cannot simply sell 3 billion of bonds like you sell 10 shares from your phone. The order itself moves the market. Prices fall, spreads widen, other algorithms react. So the system estimates the cost of the action before the action becomes visible. This is where Aladdin becomes more than risk software. It becomes coordination infrastructure. Portfolio managers see one version of the portfolio, traders see another, accountants see another, regulators receive another. But underneath, the data comes from a shared nervous system. Large financial institutions are not buying a crystal ball. They are buying fewer disconnected spreadsheets, fewer reconciliation errors, faster reporting, a consolidated investment book of record, and the ability to answer a terrifying question before the board asks it: how exposed are we? More than 100 pension plans use BlackRock's Aladdin or eFront technology. Those plans represent teachers, engineers, nurses, factory workers, people who may never hear the word Aladdin, but whose retirement institutions depend on its calculations. Every new institution adds another workflow, another portfolio structure, another reason not to leave. Changing risk systems is not like deleting an app. It means moving years of data, retraining teams, rebuilding integrations, revalidating models, reconnecting the pipes while money is still flowing. That creates lock-in, not through force, through dependency. The system becomes too useful to remove, too interconnected to replace quickly, too operationally important to switch off. The strongest infrastructure rarely looks powerful. It simply becomes expensive to live without. Here is the strange part. BlackRock's clients can include institutions that compete with BlackRock. Rival asset managers may rely on BlackRock technology to understand their own portfolios. The company is no longer only competing for assets, it is selling the map used to navigate them. The software fee matters. The data advantage matters more. Decades of market history, pricing relationships, security models, stress tests, workflow knowledge. Every crisis becomes another case study. Every anomaly becomes another input. Every client makes the ecosystem harder to replicate. Aladdin is often described as artificial intelligence. That is partly true and partly marketing. It combines models, automation, large data sets, machine learning, and human judgment. It does not wake up and decide to crash a currency. Humans define objectives. Humans approve trades. Humans choose which model to trust. The danger is not that one evil computer controls every dollar. The danger is that thousands of institutions can begin seeing risk through similar assumptions, similar models, similar data sets, similar stress scenarios, and possibly similar conclusions. If many large investors receive the same warning, they may hedge the same exposure, sell the same bonds, reduce the same positions, demand the same liquidity. The system designed to measure market risk can become part of the market reaction, not because it commands everyone, but because everyone reacts to similar signals. Prices fall. Models detect higher volatility. Risk limits tighten. More portfolios sell. Prices fall again. This is the feedback loop hidden inside modern finance. Software observes the market. Institutions respond. Their response changes the market. The software observes the change it helped accelerate. But let's be honest. This system is not simply evil. Without platforms like Aladdin, giant portfolios would be managed through fragmented databases, delayed reports, and spreadsheet chains held together by exhausted analysts. That is not freedom. That is operational chaos. Pension funds need accurate records. Banks need stress tests. Insurers need liability models. Regulators need consistent reporting. A unified platform can detect exposures earlier, reduce manual errors, improve oversight, and stop a bad position from becoming a catastrophic surprise. But stability has a price. Total centralization. A growing share of global finance depends on systems built, maintained, and commercially controlled by a small number of companies. The risk is no longer only inside the portfolios. It is inside the infrastructure used to understand the portfolios. BlackRock does not need to own every asset to influence the architecture surrounding it. Ownership is visible. Infrastructure is not. The deeper form of power is deciding how risk is measured, how information is organized, and which warnings appear first on the screen. The global economy is not run only by bankers shouting across trading floors. Increasingly, it is managed through software, quietly, continuously, in server rooms and terminals most people will never see. Your pension contribution is still there. But somewhere, Aladdin is calculating what could happen to it next. The genie is not controlling the market. It is doing something more realistic, more useful, and perhaps more powerful. It is helping the institutions that control the money decide what reality looks like.